What lies in store as the financial markets open just after 10 or at 10 this morning, following the biggest one-day fall on the stock market in a decade. That happened yesterday. Over in the United States, the Dow Jones Industrial Average plunged more than 800 points yesterday, its worst fall in 8 months, led by sharp declines in the big technology stocks. The Dow's fallen a further 2% overnight, the Nasdaq another 1%. Yesterday's losses in the US market had an immediate impact on New Zealand, with 3.64% being knocked off the S&P NZX 50 index. With what's expected today, given with what's happened in overseas markets, our guest is the Chief Investment Officer at wealth management firm JBWere, Bernard Doyle. Good morning.
Morning, Kathryn.
First, your reaction to markets that have been operating while we have been closed. Have things eased a little after yesterday?
They're still quite volatile, and that's to be expected after the move we had yesterday, and then the follow-on, the flow through to Asia makes it a little harder for things to bounce back in one day. And these days, the last half hour of trading, which we're in at the moment, is quite important as well. So we'll see things whip around, but I think, as you alluded to, we'll have another down day for sure in global markets, and that'll probably lead through to the tone in the New Zealand market today. How
big was the drop yesterday? The biggest single day drop for, as we said, a long time.
Yeah, I mean, for New Zealand, it was a doozy. It was the biggest since October 2008, and so whenever you make a comparison to October 2008, you've had a good sized move, and I think just the nature of this sell-off globally is one that, whereas in the past New Zealand's managed to probably come off as a safe, as something of a safe haven, where the nature of this sell-off is something that is a bit tougher for us to glide through.
Which stocks were most impacted?
Well, it was the growth stocks, so both here and overseas. So if you look at what sparked the sell-off offshore, it was tech stocks, many of them down in excess of 5% in one day. That came, flowed through to Asia with the Asian technology stocks, the likes of Tencent, getting hit hard. Now, the way the market tends to behave when something like that's going on is it looks for growth anywhere, and it doesn't have to be technology. So in New Zealand, we've got growth stocks such as A2 and Fisher & Paykel Healthcare, and even though, as I say, it's unrelated to the tech sector really, because they have that growth flavour to them, investors tend to shoot first and ask questions later.
If you're looking ahead at today then, with yesterday as the starting point and what happened in the overseas markets overnight as your next lot of information, what are you anticipating for today?
Well, the thing and look, the broader message from us is we don't like looking at these things day to day. But if I were to, then I'd be looking at how the US tech stocks close, because through the day they've ebbed and flowed and looked like they might be getting a bit of support, and that'll probably feed the tone for here and for Asia through today. So that's in terms of, you always when you're trying to decipher these sharp market moves, you're always saying what was the spark, what's the market focused on, and as soon as you see some relief there, that's probably when that's the sign that you could be turning a corner.
Is a correction on global stock markets, but is a correction long overdue and potentially healthy?
It's healthy. I wouldn't say it's long overdue. I mean, a stat to bear in mind is last year we had 3 days in global markets of more than negative 1% in a day. This year we've had 20. So this year has been a rocky old year, and we had a good-sized correction back in February. So I never, I certainly don't look at this current market environment and think to myself we're overdue. But having said that, there are parts of the market, and technology is the notable sector, that have done extremely well over the past couple of years. And there's nothing bad, I don't think, about them getting just the odd question mark over, is your investment case as robust as, investors have probably been telling themselves increasingly over the past couple of years, and so that part of it is absolutely healthy. Do I look at overall markets and say this is well overdue or needed? Not really. I mean, markets have been pretty flat this year. We had a very good year last year, but there's some pretty good things. It's obviously a very noisy year as well with Trump and trade and interest rates moving higher. So you can certainly see reasons why markets are asking questions, but the backdrop's still pretty good in our view.
On the question of the next economic downturn, let's look more broadly than the share market. The share market could trigger it, the share market could respond to it, depending on what it is that starts it. But a few warnings coming out of the likes of Nouriel Roubini, who's got a reasonably good track record of being a bit ahead of trouble brewing. He has just written recently with some concern about some of the fiscal stimulus policies that are happening at the moment, whether some of this buoyant growth we're seeing in the United States is the result of a stimulus that can't be prolonged over time. Are the markets, the financial markets, the equity markets, cognizant perhaps of some of the points that he is raising and that others are raising?
Yes, they are, and where you've got to be careful with, I guess, commentators that come from, not academics, probably not the right word, but are looking at themes or concepts, and I think Roubini's in that camp with respect to absolutely the US fiscal stimulus is unsustainable. I mean, their deficit's heading to, probably close to 5% of GDP. Which if you're doing that in New Zealand, there'd be a bit of a riot, and if either party was doing that. So, markets are aware that you can't keep doing that, but there's a lot of questions that have to be answered before it really becomes an issue for markets. For example, does this money that's going into tax cuts and infrastructure spending in the US currently, how much does it stimulate growth? It's certainly doing a job this year in making the US economy look bulletproof, but how does it look next year? That these are all sorts of questions that markets need to get their head around before they decide, is this good or is this bad? The one thing, to your point, that we are really focused on is how long does this global economic cycle, led by the US, how long does it continue? And because if you look at the history of separator correction, which is often a healthy blowout of froth, versus a bear market, which can last years and typically is tens of %, those bear markets almost always coincide with an economic downturn. And so, for us, that's the big thing to watch out for, is when does the global economic cycle look in danger? It certainly doesn't look in danger in 2018.
But equally, as you alluded to earlier, keeping the stock price, the stock value, in line with real underlying factors, not a sense that, hey, this party will go on forever.
Yeah, absolutely. And, this year we're seeing 20% earnings growth out of the US. They're cheating a bit with tax cuts, but to your point, the fact that equities haven't, on balance, really risen at all this year against that backdrop, that's one of the reasons I wouldn't say relaxed, but I'm not looking at this and saying this is a really dangerous mix of conditions, because we have seen the good economic growth flowing through to good market fundamentals.
Thank you, Bernard Doyle, Chief Investment Officer at wealth management firm JBWere.